Good morning, everyone. I'm Martha Stokes. I'm a chartered market technician and a psychotheorist, and I teach technical analysis. I want to share with you some more information. This is a tutorial more than an idea, but it is also an idea in many ways. It is important for you to understand that in the last 20 years, the market has shifted from being just an uptrend or a downtrend, or what they often call neutral or non-trending. Those are old words, and you need to use sideways trading or sideways trending for the modern market because that's what the professionals call it. The professional buy side and the pro traders create a lot of the sideways action. Their price differential is very, very small, very tight penny spreads, half penny spreads, and you need to learn how to read these so you can become more successful so that the market can grow and prosper because you are important. And when you lose money, that is not a good thing. You need to be more profitable. Raise your expectations. You expect so little out of the market. Oh, I want to make $100 a day. Oh, I want to make $200 a day. Pro traders would just shake their heads and say, that's what I make in a half hour or an hour, not a day. So you want to understand there are four distinct different sideways price actions in the modern automated infrastructure of our markets. And it is imperative that you understand because the market trends sideways at least 80% of the time. If you look at this chart of the SPY, you can see it was uptrending and then it corrected, then it went into a long sideways pattern. It went down in April and then bounced right back up, a very short-term correction, and then it went sideways but up, and then it had a momentum run, and then it went sideways and up, sideways and up, and sideways and up, and is trying to get up a little bit more, but it's ticked back down into this little area here. Pro traders do not drive price unless they are floor traders for the sell side institutions doing buybacks, and they do drive price upward. What's important to remember is that their price action is always a penny or a half penny spread, and they're trading on the millisecond, you're trading on the minute. So there's a lot of transactions going on here that you can't see immediately on the intraday. This is a daily chart. If we look at the daily chart, we can see that this is a sideways trend, but there are four different kinds. The consolidation is a trend sideways that has very tightly compacted price action, very tiny price action. This is really tight, but it's not as consistent as it could be because this is a sideways pattern. Consolidation, it can have a price that just goes horizontal, very tightly compacted, very precise highs and lows. Those sideways patterns that I would call a consolidation that are very, very tight are controlled by the professional traders. Right here is a little very short consolidation. They're trying to drive the price down, and they do. So they're trading within these ranges as well as trying to drive price up or drive it down. Consolidations are very, very tight. The next sideways action is called a platform. It's called a platform because has very consistent highs and lows. It is created by the dark pools only. They are in accumulation. It usually starts after a moderate correction of the market and stocks coming out of a lot of bottoms, which we have right now. So I expect to see a lot of platforms develop in the next few months because a lot of people are scared to death of the market. They think it's going to crash. They think the economy is crashing. So thus the stock market crashes. No, the stock market leads the economy. The stock market leads the economy. The stock market leads the economy. It's not the other way around. So stop listening to false information because it distorts your ability to make higher profits. And that's the intention. The intention is to take advantage of you by a lot of the uh, big people who are gambling or running guru groups or TV celebrities and so on. They're wanting to make money for themselves. They're not trying to help you. So get real. The platform has very consistent highs and lows because it is a buy zone of the dark pools, and they're pinging to buy if a price falls below their price or to their lower price and stop pinging the TWAP, time-weighted at price average in volume order type. And so it will stop pinging at a certain price range. And there is some buy and some accumulation going on in here. It's right in this range right in here. They stopped pinging here. They're not pinging at all. It collapses down. They start pinging again in here. So sometimes in a wider range. Now, the consolidation is just a few points of dimension. It's very, very narrow and tightly compacted and very horizontal. You can trace a rectangle around it very easily. The platform is very similar. It has highs and lows that are extremely consistent. And so it's a range, and it's about 10% of the price or less. It can be narrower than that, but generally not wider than 10% of the current price. And the platforms move up. They build the platforms for 1 to 3 months, and then suddenly HFTs realize that the dark pools have been accumulating and pro traders are nudging, and they gap the price up, and then it goes horizontal again for another platform for 1 to 3 months, and up and up and up. PLTR is a fine example of that. If you go back on the weekly charts, you can see that pattern. I wanted to show you this pattern because S&P has been sideways for more of the time, about 90% of the time, it's been sideways. You have to get used to and learn how to trade sideways patterns. This is a wide sideways pattern. It's not a trading range, but it is wider than a consolidation. It's wider than a platform. And smaller funds managers control price a lot of times and influence price. I can't say they control it, but they influence up and down. Pro traders are in here periodically. And so it's more volatile, as you would call it, but it's actually a choppy sideways pattern. It's choppy and it's harder to trade unless the sideways pattern is a bit wider so that you can get some nice little runs out of it for day trading or swing trading. Here's a beautiful example of an entry signal that happened over here. This is a nice entry signal right here. The pro traders were nudging it down, and then they bought the cover, and then they pushed price up. After they made their profits here, they were buying the cover. Then they started buying, and then it triggered a push up, and it ran up for several days. This is a very nice swing trading run. And swing trading is far more lucrative than day trading. It's easier, it takes less time, it takes less capital, and it's a lot more fun because not the stress of trying to get in and out with the penny spreads and the millisecond trading that's going on that you cannot see. You cannot see it. You cannot see it. It's not there. It's not visible. Even if it was visible to the naked eye, it would just be a big blur. The largest of the sideways patterns is a trading range, very hard to trade because it is so huge. If it's seen on the daily chart, you will see that there's inconsistent highs and inconsistent lows because it is dominated by the smaller funds managers who are constantly in disagreement with each other nowadays. Half of them think the market's going to go up and half of them think the market and the economy is going to crash. It's a very divided group, and it's a big enough group that it can influence price because they use VWAPs, volume weighted at price, which accelerates the price action. TWAPs do not accelerate the price action. They actually control the price action. VWAPs make everything move faster because the more volume that's coming in, and volume is based on quantity of lots, not necessarily the quantity of size of those lots. So they can be small lots and they can drive and propel the market forward. So this is very important to understand. We can see that there's a shallower volume during the periods of time when the dark pools are accumulating. That's pretty typical, that it's shallower. The big, huge volume surges are when HFTs and smaller funds are overreacting to news or whatever is going on. They're driving the price. They drove it down in April because everybody was scared. So again, we have sideways pattern. Now it's kind of popped out above that. If it can hold that, it dipped back down a little bit. But if it can start, it may trend upward and have another little nudge to push up it again. Understanding sideways patterns from consolidation, platform, wide sideways to trading range is imperative because the market shifts and moves 80 to 90% of the time sideways, as this chart truly shows. The velocity market conditions and the momentum market conditions are brief and spectacular, but you want to be in before they happen. I'm Martha Stokes, and that's the topic for today.